In this video, we're going to dive deeper into the concept of futures, which is the first derivative security that we're introducing in this course. Derivatives, as the term suggests, are financial products whose value is derived from an underlying asset. This essentially means that a derivative is an indirect contract with its price tied to some form of fixed security. Despite appearing to be a niche area, the derivatives market is huge, at times even surpassing the size of the markets for the underlying assets upon which these derivatives are based. A really simple example of a derivative would be a bet on the price of a stock without actually buying the stock. So if you, for instance, bet on that the stock price for a given company will be above a certain level in 1 year time, that would be an example of a derivative contract. In reality, however, derivative contracts are typically much more standardized, and one of the most common examples of a derivative contract is a futures contract. To illustrate why futures are so instrumental, let's revisit the example of our hypothetical cookie company one more time. We would like to sell our cookies for a fixed price to the consumer. Sugar, a critical component of our groundbreaking cookies, is purchased regularly to sustain our production. However, we encounter a significant challenge, namely, the price of sugar is extremely fluctuating. Our company reaches its break-even point at $200 per kg of sugar. If the price of sugar rises beyond this point, we face a loss unless we adjust the price of our cookies accordingly. Conversely, when the price dips below $200, we enjoy additional profits from our cookie sales. Such price volatility is not ideal for our business, since we prefer not to frequently alter the prices of our cookies, especially since we operate with slim margins, making it operationally difficult to manage even minor price increments. So, from a cookie business point of view, we're essentially interested in a contract that allows us to lock in our prices now to buy sugar at some point in the future. Furthermore, we would like this contract to be somewhat capital efficient, since we cannot afford to lock up our capital for the next year until we actually buy sugar in the future. That means we would like a contract that allows us to gain financial exposure without actually committing a lot of capital towards this trade. This is where a futures contract comes into play. They offer a way to secure sugar prices at a level that mitigate our concerns about price volatility, since a futures contract is essentially an agreement to purchase a standardized product at a predetermined price at a future date. It specifies the maturity date and the underlying product. So besides price locking, an additional important advantage of futures is that they are very capital efficient, since cash first exchanges hands at the settlement or maturity date. However, to account for counterparty risk, both parties involved in a futures contract contribute a small margin to account for price fluctuations during the time before maturity. So let's proceed with a specific example involving our cookie company. Imagine a futures contract set to expire in 1 year from now. It covers 2 kilograms of sugar, currently valued at $100 per kg. The mechanics of this futures contract require the seller to deliver the agreed-upon sugar at the time of settlement, while the buyer pays the agreed-upon cash. More specifically, in this example, on the 1st of April in 2026, the buyer of this contract pays $100 per kilogram to the seller, while the seller delivers the 2 kilograms of sugar. Importantly, until the settlement date arrives, the actual assets, so sugar and cash, do not exchange hands. Instead, just small adjustments are made based on the margin requirements. That means the buyer of the futures contract gets to keep their $200 until the 1st of April 2026 and needs to provide just a bit of money as collateral. The same goes for the seller. They do not yet provide any sugar to the buyer, but instead just provide a bit of money as collateral. Here it is important to note that the majority of futures contracts are closed before their expiration date. This means that the seller has the option to close their contract by buying it back before settlement at the current market price. This eliminates the need to physically possess the underlying sugar in this case. This procedure is actually very common among trading firms and banks, since they typically do not have any interest in physically handling the commodities. Moreover, futures contracts are not only limited to commodities like sugar. They also cover a wide array of other assets, such as indices like the S&P 500. The process for these is very similar, but with a key difference. Index futures are cash settled. This means that at the time of settlement, the cash difference between the contract's initial purchase price and its price at settlement is exchanged. There can be multiple reasons why you would want to buy a futures contract on an index. One simple reason would be that you want to bet on the index price moving up. Another reason would be to offset risk towards certain sectors that you do not want to be exposed to from other assets. Through this discussion, we've explored the vital role of futures in the financial market, demonstrating their capacity to lock in prices. One use case of this is reducing volatility exposure for businesses like our hypothetical cookie company. But also besides operational contexts, this can be used to offset risks, also known as hedging, in a capital-efficient manner for trading firms and other market participants. A further aspect that stands out is the trading hours. Unlike most stock exchanges, the futures market operates with significantly extended hours, typically 24 hours a day, 6 days a week, or 23 hours a day, 5 days a week. This extended trading window provides a unique advantage, particularly in terms of price discovery. When stock markets are closed, futures markets remain active, offering a live pulse on the market sentiment and expectations. This continuous trading allows firms and investors to gauge market movements and adjust their strategies accordingly, even outside of traditional trading hours. So, for example, if significant global events occur when the stock markets are closed, the futures market's reaction can provide early insights into how the stock market might open on the next trading day. Now, let's shift our focus to the pricing of futures, where we're going to use the S&P 500 index future as an example. As a quick reminder, the S&P 500 index is a stock index tracking about 500 of the biggest US company stocks and their performance. So imagine the S&P 500 index is currently valued at $5,000, and we're looking at a future with a 1-year maturity, assuming a risk-free rate of 5%. Before we look closer at the mechanics of futures pricing, I encourage you to think how the timing of the cash exchange impacts the price of a future. Consider this: the transaction, where cash moves from the buyer to the seller, only occurs at settlement. So in this scenario, this settlement is 1 year away. Think, how might this delayed exchange influence the futures price? To address this question, we analyze the pricing dynamics. Given the 1-year delay in payment, the future should logically trade at a premium, accounting for the opportunity cost of the seller not being able to invest that money at the risk-free rate for 1 year. Therefore, incorporating the 5% risk-free rate, the future should be priced at $5,250. This premium compensates the seller for the lost opportunity to earn interest on the funds over the year. If this were not the case, there would exist an opportunity to make a risk-free profit. Try to think about this in a bit more detail in case it is not clear yet, since especially at some firms, having a basic understanding of how futures are priced through the risk-free rate is very relevant for interviewing. So in conclusion, futures contracts are important for the financial ecosystem. They offer multiple benefits. They serve as tools for hedging, allowing businesses and investors to manage and neutralize risks by locking in prices. They also offer opportunities for speculation, enabling traders to bet on the future direction of market prices. The extended trading hours of future markets enhance their role in price discovery, providing a continuous stream of market sentiment and expectations even when traditional markets are closed. Additionally, futures are marked by capital efficiency as they do not require the upfront exchange of cash, allowing for a more effective allocation of financial resources. When it comes to futures pricing, an understanding of the risk-free rate is crucial, given that a cash exchange occurs at maturity, which can significantly influence the pricing. As a last remark, it's important to understand that investing in futures does not entitle one to any cash flows, such as the dividends or coupon payments associated with the underlying asset. This lack of direct cash flow exposure can also impact futures pricing. We will explore this concept in a bit more detail in the next video.